the accrual accounting concepts. Our study objectives for the first part of this chapter is to explain the revenue recognition principle and the expense recognition principle. We're going to differentiate between a cash-based accounting, which we don't do, and accrual-based accounting, which we have to do. And in order to do accrual-based accounting, we must explain and how we use adjusting entries and why they're needed, and we must learn the different types of adjusting entries and prepare them. And then in the second part, we'll look at the adjusted trial balance. So to begin with then. And the accountants, for the life of a business, the economic life of a business, divided into different periods. It could be monthly, could be quarterly, but it has to be a year. Fiscal year is the year which the business operates. It could be any time. It could be from the 1st of February to the 31st of January, or the 1st of January to the 31st of December. That is the fiscal year. Calendar year is January 1st to December 31st. Now, business fiscal year can be the same as a calendar year, but it doesn't necessarily have to be that way. Now, the revenue recognition principle. What we do here is we recognize revenue in the accounting period in which it is earned. It does not matter if we receive cash for it or not. It's whether we have done the job. That's the revenue recognition principle. Assume that Conrad Dry Cleaners cleans the clothes on June 30th, but the customers do not pick it up until July. Well, the journal entry in June is I've done the job, so it's debit accounts receivable here and credit service revenue. When they come and pick it up in July, they are canceling the accounts receivable. So the journal entry then is debit cash and credit accounts receivable. Same thing with expense. We must recognize the expense in the period in which it was used to earn the revenue, in a period when efforts are expended to generate the revenue. So this is the timing issues. The periodicity assumption is the economic life of the business. And that means the expense and revenue are recognized in the periods in which they are incurred. Now, the accrual-based accounting, transactions recorded in periods in which the events occurred. Now, how many times have I said this now? Revenues are recognized when earned, even if cash was not received. Expenses are recognized when incurred, even if cash was not paid. Capiche? Okay, cash basis, that's what people think we do. We don't record just when we receive cash. Revenues are recognized only when cash is received. This is not the way generally accepted accounting principles is violated. So we're on an accrual basis. So, for example, if on the accrual basis, suppose we paint a large building in 2011. In 2011, the company incurs and pays total expenses of $50,000. It bills the customer, but does not receive the payment until 2012. Well, if we're on the cash basis, in 2011, we have no revenue because we haven't billed them. But we have expenses, so we have a loss in 2011. And in 2012, we have revenue because we received the money, and we spent no money, so we have a great big gain. So this is ridiculous. The accrual base says, okay, look, you earned the revenue in 2011, you recognize it. You incurred the expenses, therefore your net income in 2011 is $30,000, and nothing happened with regards to this contract in 2012. The fact that we received the money simply means that they paid their accounts receivable. Now, the basics of adjusting entries. We have to make adjusting entries to adjust the accounts between the balance sheet and the income statement. Now, every adjusting entry contains one income statement account and one balance sheet account. Revenues recorded in the period in which they are earned, expenses recognized in the period in which they are incurred. Adjusting entry is needed to ensure that both these principles are followed. Okay? For example, types of adjusting entries. There are 4 types. Prepaid expenses, that is expenses paid in cash and recorded as assets like prepaid insurance, prepaid rent. We also have unearned revenues. That's when we receive cash and we didn't do the job. So we record it as a liability because we received the revenue before we earned it. Then there are the types that are called accruals. That is We've done the job, we've earned the revenue, but we haven't billed the person yet. We haven't recorded it, so we must record it. And there are expenses that we have incurred, but we have not yet paid in cash or recorded. So we have to make adjusting entries for each one of these types of situations. Now we'll take it. So you know when we ended up in chapter 3, we ended up with a trial balance. We made sure things balanced. Debit balance accounts equal credit balance accounts. But you know, at the end of October, we said we had 600 in prepaid insurance. We bought the insurance at the beginning of October, but by the end of October, we used a little bit of it up. We haven't recognized that. Also, there's unearned revenue down here. We received the money the 1st of October, but during October, we might have done some work. So you see, this balance and this balance are not quite right. They're too high. That asset account is too high. That liability account is too high. And there are no expense accounts down here to indicate insurance expense or service revenue earned. That's why we do the adjusting. Okay, first of all, we look at prepaid expenses. These are the easy ones. We receive cash, we record it as prepaid insurance, debit, credit, cash, but we haven't incurred the expense. Now, prepaid insurance, prepaid advertising, rent, and so on. So the costs that expire by the end of the month, we have used up some of that prepaid expense, but we have not made a journal entry for it. We must now make a journal entry at the end of the month. That's called the adjusting entry. And what we do for these types is we debit the expense, debit insurance expense, credit the asset, prepaid insurance. Or if it was prepaid rent, I debit rent expense, credit the asset, prepaid rent. And there we have. We recognize the expense here by debiting the expense and reducing the asset. All right? That's how we handle that. Here's an example. We prepaid expenses supplies. We bought supplies costing $2,500. We recorded that purchase by increasing the asset supplies. Now, at the end of the month, the account shows a balance of $2,500. However, when we count what's left on October 31st, we only have $1,000 left. So obviously, we've used up $1,500 supplies during the month of October. At the end of October, it shows we have $2,500 in supplies. We don't. We actually only have $1,000. So we make the adjusting entry. We debit the expense, $1,500, and we credit the asset, reduce the asset. And so the journal entry would be like this. Okay? On 4th, they paid $600 for a 1-year fire insurance policy. Coverage began October 1st. Sierra recorded it by debiting prepaid insurance, which is correct, and crediting cash. At the end of October, it still shows that we have an asset worth $600, but that's not true. We've used up 50 of it. So what we do, again, debit the expense 50, credit the asset 50, and we make the adjusting entry. When we post this now, our balance is $550 and not $600, so we've made that adjustment. Another type of prepaid expenses, in a sense, are depreciation. Now, we depreciate fixed assets like buildings, equipment, vehicles, and so on. And we say when we use up that, we call it depreciation. Now, what we have to do here, assume that depreciation on office equipment is $480 per year. We have office equipment $500. But here you see we've used up 1 month of it. But we don't reduce the asset here. What we do is we set up a contra asset account called accumulated depreciation equipment and give it a balance opposite this balance. And the journal entry then will be depreciation expense 40, accumulated depreciation equipment 40. And this is how we show it on the balance sheet. That's why we don't reduce the asset. So the reader looks and says, okay, they paid $5,000 for that asset, and they've only used up a little bit of it so far. So this asset is fairly new. That's the way we present, or we set up an account called accumulated depreciation equipment. That shows the amount that we have used up. This is the original cost minus the amount, so that means we still have $4,960 worth of expenses in that piece of equipment. So here's a summary for prepaid expenses. We have insurance, supplies, advertising, rent, depreciation. These are all expenses that we have paid for. Now, we record them as prepaid expenses or as assets that we've used. Now, at the end of the period, those assets have been used up. So their value is overstated. And the expenses have not been recognized. So total expenses are understated. Therefore, the adjusting entry is debit the expense and credit the asset. Now, there's the other side of the coin, which is unearned revenue. That is, and we've seen this before, situations or transactions where people pay us before we've done the job. So there's unearned rent, unearned revenue because of airline tickets or rents or what have you. That is, the cash was received before revenue was recorded. So the way we handled that is we recorded debit cash, credit unearned revenues. And therefore, when we earn the revenue, we decrease the unearned revenue by we decrease the liability account, which is the unearned revenue, and increase the revenue account. So here, when I receive money, I set up a liability account and I debit that by reducing it when I recognize revenue. For example, Sierra Corporation received $1,200 October 2nd for services to be completed by December 31st. Unearned service revenue shows a balance of $1,200 right down here because the entry was debit cash, $1,200 credit unearned revenue. That's what we did in Chapter 3. When we look at it, we have produced, or we actually earned $400 in October, but we haven't recorded that. So you see, this liability is too high. It's $1,200. It actually should be $800 because we earned $400. And the revenue is too low because it doesn't recognize that we've earned this $400. So the adjusting entry is reduce the liability and recognize service revenue. All right. So the summary for unearned revenue, liabilities are overstated, so we must and revenues are understated, so the journal entries are always reduce the liabilities by debiting it and increase the revenues by crediting it. All right, adjusting entries for accruals. Now, we're talking accrual revenue and accrual expenses. Revenues that are earned but have not yet been received in cash, or we haven't billed them. We've earned the revenue, but by the end of the month we didn't have a chance to send them an invoice and we didn't write down that we have earned that revenue. So that's exactly what we do. Adjusting entries for accrued revenue is we debit the asset account. If it's revenue, the asset account will be accounts receivable, and we credit the revenue account. In October, Sierra earned $200 for guided services that they had not billed customers for by October 31st. So the journal entry now is bill them. Accounts receivable $200, credit service revenue $200. It's as simple as that. So accrued revenues, then you debit the asset, accounts receivable. That's the only asset that you debit, accounts receivable, and credit revenue. Now, same with accrued expenses. These are expenses that have been incurred but not paid in cash or recorded. So the adjusting entry then is to record the expense and credit a payable. And that's what we do. We credit the expense and we debit the payable. So we have to pay the salary, we debit salary expense, credit salaries payable. All right. An example, Sierra signed a 3-month note payable in an amount of $5,000. The note requires Sierra to pay interest on an annual rate of 12%. So they have to pay interest every month. They haven't recorded that in October, so that's what they do. They record the expense and they credit the payable. And that's how we handle accrued expenses. So another one, Sierra Corporation last paid salaries October 26th. Hey, that's a day in infamy again. The next payment of salaries will not occur until November 9th. The employees received total salaries of $2,000 for a 5-work weekend, or $400 per day. Thus, as of October 31st, Halloween, these guys are owed $400 a day for 3 days. You see, they're not going to be paid until November 2nd, or November 9th. They get paid every 2 weeks. So we owe them. We owe them for this time period, 1, 2, 3 days. And how do I record that? Debit the expense, credit the payable. Same thing, accrued expenses. So you have to memorize this kind of stuff. Here's a summary for accrued expenses. Here's a summary for all of them. Memorize this chart. Prepaid expenses. Assets are overstated, expenses are understated. So it's prepaid insurance. What I do is I debit the expense and reduce the asset. Unearned revenues. Liabilities are overstated and revenues are understated. So I reduce the unearned revenues and I recognize revenues. So that's always the same. Accrued revenues means I've done the job, but I haven't recorded it. So assets are understated, accounts receivable hasn't been recorded, and revenues are understated. So I debit accounts receivable, credit revenues. That's the only journal entry for that. Accrued expenses, it's the opposite. I debit the expense and I record the liability, and the liability is always accounts payable. And the revenues up here, the asset up here is always accounts receivable. These are the adjusting entries that have to be made. Okay, that ends first part of this, and then we'll do the second part. Shift.